Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business, and today we're going to talk about equity. The equity section of the balance sheet. It has all kinds of curious line items in it, and I want you to understand what they all mean. If someone were to put a set of financial statements in front of you and point to one of these line items, I want you to be able, with some degree of confidence, to explain what it means, how it arises, how it relates to the rest of the balance sheet, and how it affects the other financial statements. So, let's go. Let's start by looking at the very important concept of dividends. So dividends are just when a company distributes a share of its profits to its shareholders, and that includes the preferred shareholders and the common shareholders. Unless we are being very specific otherwise, what we're talking about when we say dividends is cash dividends. So this means the company is distributing cash to its shareholders. And in order to do that legally, it has to have enough retained earnings and enough cash to pay the dividend. If it falls short on either of those categories, then it's not allowed to do that, because that's what we call a Ponzi scheme. And you can look up Ponzi schemes if you want to learn more about that, or we can talk about it in class. It's important to realize that dividends are not an expense on the income statement. That's the one thing they are not. They're deducted directly from retained earnings after the income is calculated. And unlike interest, this means that dividends are not tax deductible. The interest expense shows as an expense on the income statement above the calculation of the taxable income. Dividends are deducted directly from retained earnings. They never show up on the income statement at all, so they're not tax deductible. This means that for a company to pay dividends, it's paying out of its after-tax dollars as opposed to its pre-tax dollars. So what kind of companies pay dividends then? Well, generally companies that don't have a huge amount of growth opportunity in front of them. So when a company starts out, the investors don't want the company to be paying dividends. They want to be using that money, whatever money it's got, including the share capital and the retained earnings, to continue to grow and take on new opportunities. But as a company matures and it runs out of those opportunities, the income that it's generating from its operations should be paid out to the shareholders once everybody else has been paid. The other kind of dividend that you need to know about is a stock dividend. So a stock dividend, like a cash dividend, is the corporation distributing its wealth to the shareholders. In this case, though, the company uses retained earnings to issue new shares to the shareholders instead of cash. And it's simply a transfer, a bookkeeping entry, from retained earnings to share capital. So nothing changes anywhere on the balance sheet except within the equity section. The total equity doesn't change, but a value is transferred from the retained earnings line, which was a credit account, so we debit that, to the share capital account. So the relative weight within the equity section of those two lines changes. And at the same time, the company legally issues the new shares to the shareholders through the appropriate mechanisms. So what does this mean? It means that the company has not lost any of its cash, but it has locked in some of its retained earnings and made it impossible for it to use those retained earnings for any other purpose, because it has effectively returned that portion of its wealth to the shareholders, distributed that portion of its wealth to the shareholders without parting with any cash. So it's interesting, I keep struggling here over the difference between the word return and the word distribute. So when shareholders initially set up a company and they buy the shares to start up the company, that's their money going in. And then the company operates and generates a lot of cash. And that cash can be used to pay everybody who's contributed to the company, including the employees and the suppliers and the banks and so forth. And then what's left over can be distributed to the shareholders. So that's not returning money to the shareholders, even though I keep saying that. So the purpose here, as I said, is to lock in the retained earnings, because as we saw in the previous slides, the company is not legally able to issue cash dividends unless it has sufficient cash and sufficient retained earnings. So by reducing the retained earnings line on the balance sheet, it is limiting its ability to distribute the cash to the shareholders. And this is great for the creditors, because it means that that cash that's sitting there on the balance sheet can only be used for other purposes. It can't disappear and go into the shareholders' pockets. So if you're a supplier, you like that because it means that the cash is available to pay your invoice. If you're a banker, you're excited about that because it means that you can safely or more safely rely on the company paying off its debts to you. So that is going to not change the debt to equity ratio, but it's going to change the interpretation of the equity section in that calculation. So this is really kind of important concept, even though you don't necessarily see stock dividends being the most frequent thing that a corporation does. This is a really interesting thing to wrap your head around because it helps you understand that you can't rely on simple calculations like debt to equity to really understand what's going on with a company. You have to look a little bit deeper to look into the nuances of those calculations. The other thing to keep in mind is that this doesn't prevent the shareholders from getting their hands on cash. They're perfectly free to sell the shares that they get to other shareholders and get cash for them, particularly if the company is a public company where the shares are traded on the stock market. It's fairly easy to do. So by giving a stock dividend to the shareholders then are in a position to either hold on to their shares and simply have a larger number of shares within the corporation, although that doesn't change their relative position to other shareholders because everybody got an additional quantity of shares in proportion to the shares that they originally had. Or they can turn around and sell those shares to other shareholders and get money that way. So they get cash, but not from the company. They get it from other shareholders. The next concept I want you to think about is residual rights. So this has to do with, the winding up of a company. And it's got to do with the priority of claimants on the company and who ends up with what's left. So the legal framework for this is that there's a class of claimants. You'll see it in line number 2 there is really the important line that everything starts with, the secured creditors. These are the creditors that have loaned money to the company, but they've got some kind of a legal claim on the assets of the company. They might be the mortgage holder on the factory, or there might be creditors that have a lien, say, on inventory or something like that. So all of these are secured creditors, and they have a higher priority than the unsecured creditors. So that's just done within the legal framework of the contracts with the company. But the legal system in most democracies has established a class of claimants that are even higher priority than the secured creditors. So these are what's sometimes referred to as the super priority claimants. Not a phrase I'm expecting you to remember, but you should understand that these claimants do exist. So for instance, your employees are often protected from the company winding up and going without their wages. So there'd be an Employment Standards Act in, say, the province of Ontario. I think that might be one of the places to look for this kind of a legal clause that says before a company can pay its secured creditors, it has to pay the wages that are owed to the employees. Same thing with any pension benefits that are remaining to be paid. If there are contributions to the pension plan that were supposed to be made, those might be legally enforceable before the secured creditors. And of course, if the company has made deductions from payroll, for EI or CPP, those deductions would have to be remitted to the government before money could be paid to the secured creditors. And oftentimes property taxes have to be cleared up because otherwise the property that the company sits on, the land, can't be sold to generate wealth because the city would have a claim on the property itself. So that has to be cleared up before the property could be sold and the proceeds used to pay off the other creditors of the company or the shareholders. That's all the creditors, right? So those unsecured creditors are kind of the last in the list there, but they still get paid before the shareholders, and the shareholders then would be paid off in the order of preferred shareholders followed by common shareholders. And the point here is that the common shareholders get whatever's left. So if the company has done well and has lots of assets and has decided to simply wind down its operations, it can pay off all the super priority claimants and all the creditors and the preferred shareholders, and there may be a huge windfall left for the common shareholders, and they get to party on that. But, of course, if the company has done poorly, those secured creditors and unsecured creditors probably use up everything that's left to the company, and there's nothing left for the preferred shareholders and probably certainly nothing left for the common shareholders. So when a company goes bankrupt, the common shareholders typically have lost their investment. They may have recouped some of that through dividends along the way or through selling some of their shares that grew in value temporarily. But if they're left holding those shares at the end of the day, those shares could be worthless. The concept of preferred shares hinges on this notion of preferred. And all it means really is that the dividends on preferred shares are paid before any dividends are paid to common shareholders. That's the preference. The preferred shares don't really have any other preferential standing. They don't have typically any voting rights at the annual general meeting, and they don't get the claim on the residual wealth of the corporation the way that the common shareholders do. So there's really no upside, but they do have a priority on getting paid dividends. And oftentimes you'll see preferred shares issued by established corporations like GE or something like that, that have steady cash flows and can pay out these dividends often at an attractive rate of return. So preferred shares are often a big part of the portfolio of older investors who are using their portfolio to generate income for them to retire on. What else do you need to know? Well, preferred shares, like bonds, are what's considered a hybrid security because they have all kinds of little features built into them to sweeten the pot for the preferred shareholders or to dilute the claim of the preferred shareholders in order to protect the rights of other creditors or common shareholders. So you have to look carefully at the features within any particular preferred share. Not all preferred shares are created equal. One of the frequent features that you see in a preferred share is that they're convertible, in that they might be convertible into either another class of preferred shares or into common shares. And of course, the value of the preferred share on the market depends on who has the option to make that conversion. If it's the preferred shareholder that has the option to switch those into common shares whenever they want, then that might be something that makes the preferred share more valuable. If it's the company that gets to say, look, we're tired of paying dividends to preferred shareholders, we're just going to switch those out for you and give you common shares, then of course those preferred shares are slightly less valuable. There's also other features like, whether the preferred shares are cumulative. The payment of dividends to preferred shareholders is at the discretion of the corporation. They may choose not to pay the dividends one year if they don't have enough cash. And that's not a great sign. That value of the preferred shares is going to drop and the preferred shareholders aren't going to be happy. But if those shares have a clause that says they're cumulative, it means that before the company can ever in the future pay dividends to its common shareholders, it has to make up for those missed dividends to the preferred shareholders and pay all of the outstanding preferred share dividends, regardless of how many years it is, before it can issue a cent of dividend to the common shareholders. So that's another feature that can make those preferred shares slightly more valuable. Common shares are the most common kind of share, and they simply mean that they are the original shareholders of the corporation. You can participate in that when the company issues new common shares, so you don't have to be there at the very beginning. But those common shares are the ones that, when you're talking about people voting at the annual general meeting, it's the common shareholders that vote on things like the election of directors, the appointment of the auditor, and any extraordinary resolutions that come along. Oftentimes, those shares have different voting rights. There might be more than one class of common share, like Class A, Class B, Class C shares. So if you look at Magna International in the past or Bombardier today, you'll notice that there's multiple classes of shares, and the founders of the company, Frank or the Bombardier family, will have those specific shares that give them way more voting rights per share than the other class of common shares. And that means that those companies are controlled by the founder. And you may find, like in the case of Magna, that the dividends were distributed evenly across all classes of shares, but that the control of the decisions, such as the appointment of directors, was completely in Frank Stronach's hands. So you always have to look at all the classes of shares in a company in order to understand the power structure. This brings us to the topic of stock splits and stock consolidations. So oftentimes a company has a certain number of shares that have been issued, but then it will split those shares or consolidate them. Now, this is different from what we're talking about when we say we're consolidating the financial statements. This is a stock consolidation. And what happens here is that you've got, say, the common shares, and the total value of the shares, it might be they're worth $5 per share, and there's 1 million shares out there, so they're worth $5 million. The total value, that $5 million figure, doesn't change, but the number of shares will change by the company either splitting the existing stocks into multiple new shares or by consolidating the stocks down to a fewer number of shares. So with a stock split, the existing shares are exchanged for a new number of shares that are of lower value. So, here we've got the example of 1 million shares at $100 becoming 5 million shares at $20. So if you do the arithmetic there, it works out to the same, $100 million of share capital. The number of shares has increased, but the total value has not. So it's just the share price that has changed. And this is just done through filing on the stock exchange saying we're going to do this. There is no reason to object to this if you're a shareholder. What this means is that smaller shareholders can buy and sell shares now because they can afford to buy a couple of shares where they possibly could not afford them before. So when you see, Apple or Samsung shares going up and up and up in value to the point where the average person can't buy even one of them, this makes it difficult for people to trade their shares. It makes it difficult for people who own a small number of shares to sell off like 10% of their holding. If they only own 2 shares valued at $1,000 each, they've got a choice between holding on to everything or selling off half their investment. That might not be what they want. So if the company splits the shares, it makes it easy for them to increase or decrease their investment in the company by a little bit. Consolidation is working the other way around. Suppose that you had a company that had 5 million shares at $1 each. If those shares continue to drop in value, there's a possibility that the rules of the stock exchange would say you can't trade on this exchange. We don't trade shares that are worth lower than a certain threshold. So to avoid being delisted by the stock exchange, the company might consolidate its shares. So it just takes those shares and collapses them into a smaller number of shares at a higher value. The total value of those shares doesn't change, but there's fewer shares on the market. So if you are a shareholder that had, 10 shares before, you now have 1 share and it's worth the same $10 figure. The accounting treatment for this, either a split or consolidation, basically is immaterial. There's no change on the financial statements at all other than the number of shares. Share repurchases are a different thing, though. This is a complicated topic, so let's walk through this slowly and try to figure it out. A share repurchase is the company buying shares back from the stock market, and it buys them at the market price. So when a company issues new shares, it tries to estimate what those shares will be worth, and it puts a value on those through the underwriter, and they're put up for sale on the stock market. People will bid on those, and the price that people are willing to pay for them might be lower or higher than anticipated. Sometimes when the company issues shares, it might deliberately underprice them to make it look like, oh, everybody's crazy about this stock. Look, it's trading at higher than its issue price. That can generate some excitement around the company. But, there's a cost to that because those shares are being traded after they're purchased, and the company is not necessarily participating in all of that well. So a share repurchase is the opposite sort of thing, where the company is taking those shares back into the company, but it has to buy them on the market at a certain price. And there's various reasons to do this. So one of the possibilities is that it might know something about the plans of the company that it can't disclose for proprietary reasons. And it wants to signal to the market that those shares are really trading at less than the company is worth. And if you only knew these secret plans of the company, you would realize how valuable those shares are. So in that case, the company might want to signal to the market that those shares are undervalued by buying back a small number of shares, a significant commitment by the company to make a strong signal, but not enough shares that it takes a lot of shares off the market. And so this is just telling people that the company thinks those shares are a bargain at that price. And it's more of a semaphore than anything else. The intention is not to take shares away from the shareholders, but simply communicate information in this kind of a way. The other possibility is that you're actually trying to reduce the number of shares on the market. It has the effect of consolidating the control of those people that already have a dominant position in the market in terms of the percentage ownership of shares. And oftentimes this is, the CEO, the CFO, the chairman of the board, and so forth, that are able to consolidate their control. Or it might be that you've got one particular investor that owns 20% of the shares, maybe the founder of the company, who has slowly been selling off shares of the company in order to generate wealth. They may have changed their minds and maybe they want to consolidate their control of the company, and they have the company use the company's money to purchase the shares of other people and increase the position of the dominant shareholder. So this is, purely about power. You have to look at the reasons for this, and oftentimes it's not clear why a share repurchase is being done. So look at the distribution of the shares. Look to see if there are dominant shareholders and who they are and what they might stand to gain from a share repurchase. Another possibility is that the company is simply trying to take the wealth that it has and distribute its retained earnings to the shareholders. So what are the reasons for this? Well, instead of paying a dividend, a share repurchase puts the option in the hands of the shareholders. So the individual shareholders are operating on the market to decide whether they want to buy or sell their own shares, and they could sell their shares to anybody. So if the company announces that, next Friday we're going to be buying 10 million of our shares off the stock market, the shareholders that hold those shares can decide whether to participate in this. They may decide that they would rather have a higher percentage position in the company and simply not sell their shares and allow other shareholders to sell their shares back to the company. And that means that they have shares that are now worth a little bit more because they own a bigger percentage of the company. The other thing is that when the company does this, it allows the company to use its retained earnings, even if the retained earnings figure is low. So you recall that if the company decided to do a cash dividend, it has to have sufficient retained earnings to cover that cash distribution. And if it doesn't, it's not allowed to do that by the stock exchange. It's not the same for share repurchases. A company can go into a negative retained earnings position when it does a share repurchase. And there's no rules against that because it's actually buying back shares. So there's a different rule in the stock market for this kind of a distribution to the shareholders compared to a dividend. But it's the same sort of thing, right? With a dividend or with a share repurchase. Some people might prefer that the company hold on to that money and reinvest it. So with a share repurchase, people have the option of just holding on to their shares and telling the company to hang on to that money. Of course, that money goes out to other shareholders, but then those shareholders are out of the way and the remaining shareholders have more influence over the company. This is all about distributing wealth without having to worry about the rules restricting dividends. So how does this work then in terms of accounting? So the company goes and it buys back its shares on the open market, and this reduces its equity because it's using its cash to reduce the number of shares. So the number of shares goes down. And I'm going to show you what happens to the different lines in the equity section of the balance sheet. To follow the bookkeeping, you just have to keep in mind that there's three possibilities that we're going to account for. One is that the shares are repurchased and then canceled, which means they're eliminated from circulation. And in that case, you have to think about the two possibilities, whether the shares were repurchased either at a higher or a lower value than they were originally issued. And the third possibility is that the shares are repurchased, but they're not canceled, they're held on to. And they're sitting there in the company with the possibility that they'll be sold again, reissued out to the stock market. So I'm not sure whether the word reissue is actually the accurate word to be using there because there's this concept of shares being issued and outstanding. So the company issues a number of shares and then it sells them, and those shares are issued and outstanding. And then when the company buys shares back, if it holds on to them, they're issued but not outstanding. So it's hard to know exactly what term to use for these things. It all gets a little bit confusing. And I'm not really interested in a memory test about which terms you can recall and define precisely. It's the concepts I'm interested in making sure you understand here. So the key distinction here is twofold. When the shares are repurchased, are they canceled or are they held on to for future use? And if they're canceled, then we have to look at the price that was paid on the repurchase. So let's look at what the journal entries are like for this. Here's what was a 2x2, but you'll see the bottom portion of the 2x2 has been merged into one because when the shares are not canceled, there's no difference of how the price that was paid related to the original price of the shares. So maybe let's deal with that first of all, because that's the simplest one. So when the shares are purchased off the stock market, but the company just holds on to them, they're put in what's called treasury. So that is just a line in the equity section called treasury stock. The company has to pay cash for it, let's say $2,000 in this case. If that's in thousands of dollars, that would be $2 million, right? But it's got this $2,000 figure that is a debit, and that is a contra account. It's a contra account in the equity section. So in the equity section, you're going to have a line that says share capital, and you're going to have a line that says retained earnings. You're going to have a line somewhere that says treasury stock. And because it's a contra account, if it's not significant, you might just have that netted off against the share capital account for disclosure purposes. But that treasury stock is a reduction to the equity, and the entry is not made directly to the share capital account. So the value of the share capital account doesn't change. You've simply now got to net that value off against the treasury stock account. The repurchase shares are listed as issued but not outstanding. The important thing there is, of course, if the company's holding on to them, it doesn't pay dividends, right? Not eligible for dividends. So if it pays dividends to the common shareholders, it's only those shares that are issued and outstanding that get the dividends. So in this transaction, because the purchase price is not considered in relation to the original price that was paid, there's no gain or loss to worry about. It's just a simple journal entry as shown. And those shares then sit in treasury and they're available for later sale. But they're also available for later cancellation if the company decides to cancel them. But that's the second step that I think you can figure out once we look at what happens when shares are repurchased and canceled. So let's look at that other scenario then, where the shares are repurchased, brought back into the company, and basically electronically torn up. So what happens there? Let's suppose that the company has bought those shares at a price that was greater than the original price in which they were sold. In this case, let's say that you're buying back shares that were originally sold for $1,000, and they're trading on the stock market for a value of $6,000. They've gone up sixfold. So you have to pay $6,000 in order to get them back. So what happens to that difference then? The difference goes to retained earnings. That's a debit to retained earnings. So that $6,000 comes out of cash, and in order for the transaction to balance, we have to reduce the equity section by $6,000. The first $1,000 is to deal with the price that the company received when it sold the shares, and the balance has to go to retained earnings. So this is a use of retained earnings to distribute the wealth of the company to the shareholders. So the $6,000 of cash goes out to those shareholders, and the retained earnings goes down. It's important to realize that there's no restriction on the eventual balance of the retained earnings. If this was a dividend, using cash to pay a dividend, that retained earnings balance cannot go below zero. But with a share repurchase, there's no restriction on that. You could go negative on your retained earnings. So remember, retained earnings is normally a credit account. If you put a big debit in there, it could end up being a negative number in the equity section, and the company would be operating in a accumulated deficit position rather than a accumulated surplus in the retained earnings. So that's what happens when the repurchase price is greater than the original share price. Let's look at what happens if the repurchase price is less than the original share price. Those shares that were originally sold for $1,000, if those shares have gone down in value and they're only worth $800, then the company only has to part with $800 of cash. And so to make the transaction balance, we need another account in the equity section called contributed surplus. It's going to be a credit account, and it's going to be, in this case, $200. So that's going to be another line in the equity section. You'll have your share capital account, which is a credit account. You'll have your contributed surplus account, which is a credit account. And then you'll have your retained earnings underneath that. This situation doesn't increase the value of the retained earnings. The previous scenario decreased the value of retained earnings. This does not increase retained earnings. We put the surplus in a separate line called contributed surplus. Now that contributed surplus account has another function, and that's completely separate from share repurchases. You may have seen this line before in relation to shares that are sold at a par value. Oftentimes, common shares are sold without a par value, and whatever people pay for them just goes into share capital. But if those shares have a $1 par value printed on them, that's a nominal figure that's kind of an archaic feature of 1920s or 1930s facilities for raising share capital. Companies sometimes do that just out of tradition. So if somebody had paid $1,500 for shares that had a $1,000 par value, so 1,000 shares at $1, and you paid $1.50 for each of them, the company would record that as a debit to cash of $1,500, a credit to share capital of 1,000, because that's the par value, and the remaining $500 would go into contributed surplus. It would all be in the equity section. And in order to understand the total value that the shareholders had contributed to the company, you'd have to add up the share capital line and the contributed surplus line. And that's purely because those shares happen to have this thing printed on them that said par value $1. It could have been par value 10 cents or anything. But that's where that contributed surplus line comes from. So the scenario we're looking at here on this slide is a second situation in which contributed surplus can arise. And that's when the company buys back shares, but they've gone down in value since the company originally sold those onto the stock market. All right, so all very complicated bookkeeping and a little tricky to keep track of. It's worth your while to pay attention to how that bookkeeping is done, because I might ask you to explain it. I'm unlikely to ask you to memorize all of that because I have a hard time keeping it straight. It's very technical. But I might ask you to explain, why in some circumstances retained earnings is debited, in other situations contributed surplus is credited, or what treasury stock is, what purpose it plays. So pay attention to these. It's a good short answer essay question on an exam. Since we're talking about the equity of the company, let's talk about employee stock options. Very popular topic for MBA students. An employee stock option is basically the right to buy shares at a set price. And there'll be a number of features that are included in the stock option. There'll be a vesting date, and that's the date at which the employee can begin to exercise the stock option. Until that point in time, the employee basically has this piece of paper that is worthless to the employee. And this is to keep people from collecting their stock option and then walking away from the company with a windfall. There's an expiry date, so that the employee would have to exercise the stock option on or before that date. Sometimes stock options specify that the option can only be exercised on a specific date. In other cases, the vesting date and the expiry date will be different, and the employee can exercise the option anytime between those two dates. That makes the stock option more valuable because it gives the employee the option of buying the stock if the stock is valued really high and is afraid the stock price might go down. And of course, the difference between the exercise price, that's the price that has been specified for the employee to buy the shares, the difference between that and the market price on the day of exercise is going to be basically a gain to the employee. So the higher the price, the better. And that's why employee stock options are used by management ostensibly to provide an incentive to those employees to work in the best interest of the shareholders rather than in the employee's own interest. Employee stock options are based on a very dismal view of human nature. The other thing, of course, that has to be specified is the number of shares. You can't allow the employees to buy whatever number they want, so there'll be a specific number specified in the stock option. When the employee does exercise the stock option, whenever that is, the company has to do a couple of things. The first thing is it has to issue the new shares, and this dilutes the position of the existing shareholders. So when you see on the bottom of the income statement the earnings per share, basic and diluted, this is what's taken into account in that diluted figure. The basic is the earnings of the company that year divided by the number of outstanding shares at that year-end date. But the diluted number is the earnings divided by the outstanding shares plus all the options that have been awarded to employees. So that being a greater number on the denominator, it means the earnings per share will go down. And that's a signal to other investors that if they're buying a position in the company, there's a good chance that their percentage interest in the company is going to go down because of the exercise of these stock options. So once the company has issued those new shares, it's not going to issue them onto the stock market. It's just going to issue them legally and give them to the employee at a given price. So it sells them to those employees at the exercise price. And that's the transaction that happens. The company gets some money and the shares get transferred to the employee. So that's a simple share transaction. However, that takes place at a lower price than the market price on the day. The employee, of course, is only going to do that if the market price is higher. Otherwise, why buy them from the company exercising the option? Just go buy them on the stock market. So that means that the stock option is considered an expense to the company because the company has incurred an opportunity cost because they could have sold the shares on the market that day. However, the expense is recognized when the option is given to the employees because that's the decision of the company on that day to issue that stock option. That's the date at which the expense can be recognized. The cost of the stock option, the expense has to be calculated based on the present value of this opportunity cost. Takes into account a number of things. It takes into account the likelihood of the option being exercised, and that's because the employee might die between now and the vesting date, or the employee might get terminated, in which case the options would never be exercised. It takes into account the price that's promised to the employees. That's the exercise price, and the company then has to estimate the future market price of those shares. And that becomes very complicated when the employee has a long period of time in which to exercise the option, not just on a specific date, which is hard enough to estimate the stock price for that date, but over a period of time. And that may mean that the shares could fluctuate in value during that time. The company has to make some sort of an estimate of when it's likely for the employee to exercise the price and what the price might be and so forth. And of course, all of that takes place in the future. So you have a discount rate and a time period that has to be taken into account in the actuarial model for this. Now, the final thing to think about is this. Share repurchases by the company are going to raise the value of the stock options that have been awarded to the employees and the directors. So if an employee has a stock option and the company repurchases shares at any time between now and the exercise date of the stock option, those shares that the employee is going to purchase from the company at the exercise price would represent a larger percentage of ownership in the company. So anytime the company repurchases shares, it's raising the value of the stock options. And those stock options might have been awarded to employees like the CEO and the CFO, and they might have been awarded to the directors. So if you think about this, that may go a long way towards explaining why Apple chose to repurchase shares rather than simply award dividends to all the shares out on the stock market. That share repurchase increased the value of all the stock options that had been awarded to the CEO, to the CFO, and to the directors. And so that's, I think, a possible explanation for that because it's in the self-interest of the board members, which includes the CFO and the CEO, to execute a share repurchase because that raises the value of those stock options that they're holding. Curious feature of the stock market, isn't it? Now I want to look at a very common item on financial statements called non-controlling interest. And what I want you to look at is this line here. This is from the Saputo financial statements, which we've looked at in previous lectures. Here you've got the statement of earnings, and down at the bottom, you've got this line that says non-controlling interest. That appears on the income statement, right? So it's taking this figure here for the net earnings and is dividing it between the shareholders of Saputo and this thing called non-controlling interest, and the total matches the total of the net earnings. Let's look at another place where this appears on the financial statements. On the statement of comprehensive income, you've got this comprehensive income number that is distributed across the shareholders of Saputo and this non-controlling interest, whatever it is, the total matching the comprehensive income. We also see it on the balance sheet. Here I reproduce the liabilities and equity section of the balance sheet, just trimmed off the asset section for clarity. And you see down here that you have the total liabilities and you've got the total equity, but that total equity number is distributed between the equity attributable to the shareholders of the company and the equity that's attributable to the non-controlling interest. So what does all this mean? Non-controlling interest arises when you consolidate the financial statements of a number of companies. You've got the parent company and you've got all of its subsidiaries. And this includes all subsidiaries that are controlled by the company, even those where the company doesn't own 100% of the shares. If the company only consists of a parent company and subsidiaries that are owned 100%, you're never going to see non-controlling interest. So it only occurs when a company owns between 50 and 100% of another company, of a subsidiary. If it controls less than 50%, it's not going to consolidate those companies' financial statements into the parent company's financial statements at all. It's going to account for them in a separate way, which we'll talk about in a minute. But if it controls between 50% and 100% of the shares, it's considered that the company has full control over all of the assets of that company. Regardless of whether it owns 100% of them, it's got 100% control because it's in a majority position. Therefore, in order to represent the assets and liabilities of the total conglomerate properly, you have to consolidate all of the assets and all of the liabilities into that company because that's what the company controls. It controls 100% of those assets and liabilities, but it doesn't retain 100% of the benefits of that because a small portion, less than 50%, of some of those subsidiaries is actually owned by somebody else. So that's what non-controlling interest means, and it's a portion of a controlled subsidiary that was consolidated into the parent company's financial statements, but it actually belongs to the non-controlling shareholders, those shareholders that own the remainder of the shares in the subsidiary. So oftentimes in a company like Saputo, the non-controlling interest is quite small compared to the overall assets of the total conglomerate. And that's because that company also owns the total assets and liabilities of any subsidiaries that it owns 100%. There might only be a few subsidiaries, and they might be small, in which the company owns a less than 100% stake. So the non-controlling interest is only the portion of the wealth of the conglomerate that pertains to those minority shareholders in those handful of subsidiaries where the company doesn't own 100% of the shares, but still owns more than 50%. So that's what that non-controlling interest line means. It means that on the income statement, a tiny portion of the total income of the conglomerate actually is attributable to the shareholders of those subsidiaries where the company owns less than 100% of the shares. And a portion of the assets of the conglomerate are actually owned by the shareholders of one or two subsidiaries that the company might own less than 100%. Difficult concept to explain, but easier to understand than put into words. Let's try and take stock of what we've learned. We've gone over equity. We looked at the different kinds of dividends, cash dividends and share dividends. We looked at all the different types of equity. We looked at employee stock options, and we covered share repurchases, splits, and consolidations. Again, remember that word consolidation is used in two different ways. Here, we're talking about the consolidation of shares by a company when it wants to take a whole bunch of shares of small value, consolidate them together to make a smaller number of shares that are each worth more. The purpose is not to turn you into an expert. It's to make sure that if someone were to put a set of financial statements in front of you and say, what's that mean? Then you should be able to explain it.
It's all about money, money.